Okay, let's get started. All right. Thanks everyone for attending. Hi Pierre, good to see you. And so this is the fifth webinar of a series of 7. This one is technical analysis module 3. Okay, and looking forward to this. So yeah, over to you, Pierre.
Thank you so much, Ross, and welcome everyone. It's always a pleasure to have you all with me for our sessions regarding how to build a trading plan. Basically, this is the objective at the end of this 7 live webinar series. So it's already the 5th session. We've come a long way, honestly, since the beginning of that webinar series, and this is the last module about technical analysis, right? So we're gonna talk today about the technical indicators. All right. So, but first, let's move forward with a little disclaimer. All right. So this presentation is for information only and does not constitute advice. CFDs are, of course, complex instruments and come with a high risk of losing money rapidly due to leverage. 53.9% of retail investor accounts lose money when trading in CFDs with this provider. And you should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. CFDs are provided by Global Markets Group Limited on an execution-only basis. We do not provide any advice, and any written or verbal communication with us should not be considered as such. All right, so let's go. You know the drill now. It's the 5th session already. You can, there's going to be a short Q&A at the end of the session where I'm going to take the necessary time to answer each and every one of you. But if you have some questions that comes to your mind throughout the session, please feel free to type them in the chats. All right. So now, first off, today, this is very important actually. Today is about decision support. All right. I know that some of you are already experienced traders. You already heard about technical indicators. Some of you haven't. All right. And this is what we're doing tonight. We're here to clear everything about that. We're going to explain, how they work, how to interpret them, and what kind of usage we can make of them. So today is about decision support. All right, technical indicators are decision tool basically. They are not crystal ball or prediction. All right, nothing is when it comes to trading anyway. Indicators simply help us see trend and momentum more clearly so we can act with rules. Okay, these are in the opposition of gut feel, for example. We're going to keep it practical, all right? I know that there's an infinite number of technical indicators on most platforms nowadays, and we have even new ones getting invented almost every day. So we're just going to keep it practical for this session's sake, actually. And we're going to talk about, I've picked three among the most popular ones. So we're going to talk about moving averages for trend, mostly, and pullbacks. RSI and stochastics for breakouts confirmation, with trend lines and divergences. So those three, I mean, RSI and stochastic are from the same family, if I may say so, of technical indicators. They are we can use them in the same way. They tend to deliver the same message. It's just the only difference between them is the RSI is for a longer term use than stochastic, whereas moving averages, this is I think is the most popular one actually, is a trend following indicators. We have many of them actually. We have the Bollinger's Band, we have the Ishimoku for those who knows, but I've just picked the moving average. I think it's the easiest one to understand. All right. So this is what we gonna be doing today. All right, let's move forward. And please, before I start, Ross, don't hesitate to interrupt me if you see any questions or anything like it. Okay.
Do you want to put the poll out to people right early?
Okay. Let's go.
Yeah.
Why not, actually? Yeah,
Okay, then we
definitely.
know you can dictate it, or you can kind of gauge your audience then, okay?
Absolutely.
Okay, there you go. It should come through. There should be some 3 questions, guys. It won't take you longer than a few seconds to answer. Technicals, fundamentals. What are you, Pierre? Are you a bit of both, or are you purely technical?
Well, I've started, entering the trading industry or the trading world, if I may say so, with a technical. I've
Hmm.
passed this worldwide certification in technical analysis, but then throughout experience, I've learned some fundamental skills, and now I like to do a bit of a, mix of both, if I may say it like
Okay.
this. I think it's important, technical is going to tell you uh, what's happening. Fundamental is going to tell you why it's happening. So I think it's good to
Mm.
know a little bit of both. You don't have
Yeah.
to be.
I think the audience is agreeing with you as well. Okay,
Okay.
so yeah. All right, go on then.
All right.
Crack on. Yeah.
All right. Good. So let's move forward with this first slide. So first of all, I want you to think of price, right? I'm talking about the candles right here, as noisy audio and indicators as the equalizer, kind of like. They transform raw price into clearer trend or momentum signal. When you think about it, price itself, candles themselves are your first technical indicators when you think of it, because all of the technical indicators, no matter if they're trend following indicators, oscillators, any volatility, anything, they are derived from price. So there's always some sort of delay. The first indicator that provides you with all the information you need, all the information available on the said markets, are the candles themselves, right? So this is important to bear in mind. So now indicators, because we know markets can be volatile, and sometimes, especially when you trade on a very, very short-term time frames, you can see a lot of volatility, a lot of noise, right? We covered that throughout the last sessions, and in technical indicators help us to get a clearer picture of the trend or the momentum signal, and that clarity comes with lag. This is what I just said, basically. So we always combine signals with market structure. This is very important, guys. When I talk about market structures, I refer to swings, price swings, recognize supports and resistances, or just a simple trend line, for example. The indicator sets the context. Price action triggers the trade. Very important. All right. Let's move forward. The first thing to do when you want to set up a technical indicator is to pick a period. Like, okay, so now I need to explain that clearly. So um, it's the period, it's an amount of, I was about to say an amount of days, but if you're not trading on a daily chart, it doesn't make sense. But it's an amount of candles that the technical indicator is going to base this calculation on, right? So now before you ask, there are no bad or good periods for moving averages, RSI, anything. Okay, there are no good or bad periods. You just have to pick periods by job to be done. So now, of course, you're gonna do it according to your trading horizon. If you trade on a daily chart, if you trade on a M1 chart, for example, your strategy, the signal you want to get, the how strong you would like the indicator to eliminate the noise of the market and things like this. So pick periods by job to be done. For example, 921 for moving averages for intraday speed, 20 to 50 for swing balance, 100 to 200 for position stability. All right, but bear in mind something. Faster, so the smaller the period, and basically the I mean the more responsive the indicator is going to get, but you're going to get choppier signal as well. Slower or a longer period is going to provide you with less signal, it's going to be calmer, but it's going to provide you with more delay. So if you increase the period of a technical indicator, of course, the signal you're going to get are going to be, the amount of signal you're going to get are going to be lower, and they're going to be more efficient, more quality, but you're going to have more delay. And this is important to bear in mind, especially for short-term traders, scalpers, or intraday traders, right? So now you want to use the higher time frame to define bias, and then move on to a lower time frame to time entries. This is the logical way to approach the market, if even when we don't talk about trading, but just if you want to analyze a market, for example. Choose default per asset and avoid endless tweaking. So you just want to define like some sorts of basics in the sort of a routine, when analyzing a chart. So now we're going to move forward with the first technical indicators. Of course, I'm obviously talking about the moving average. So now there are different kinds, different categories of moving averages. I'm just going to talk about the simple one and the exponential one. All right. But it's the same principle, basically. So SMA, or simple moving average, averages equally, whereas an exponential moving average gives more weight to recent bar, right? So this is important to bear in mind. So first, you want to read the slope. Okay, this is the first thing to do to identify the trend, right? Because if it's rising, if the slope is rising, it means you are in bullish conditions, in a bullish environment. If it's falling, it means, on the other hand, you're in a inside a bearish trend or in a bearish environment. If it's flat, it means you're at risk, because again, moving averages are a very good tool for directional markets. It doesn't work well when the market is ranging, when it's trading inside an horizontal channel, for example. So this is a risky condition if you're using that indicators. In trends, although MAs often behave like dynamic supports and resistance during pullbacks, which are great places to look for entries if the structure agrees. I'm going to show you some example afterwards. So now I have a little playbook for you already. So let me walk you through it. So let's say you are in a bullish environment and you want to, you expect the market to trade higher and higher. You want to enter the market with a long position. So in an uptrend, you would like to wait for price to pull back towards a rising, for example, 2021 period EMA, exponential moving average, then pause near prior swing support, then enter on the first higher low micro break. Then you're going to place your stop under the pullback low, trail with like a moving average 20 period or an ATR. So ATR, I'm not going to go too much into the details right now, but ATR is an oscillator aiming to provide you with some information regarding the market's volatility, right? So trail with a 20 period moving average or ATR and take partials at prior highs. Cautions though. Caution, when a moving average go flat, expect whipsaws. Better to stand down than donate, honestly. So this is it for the moving average. Again, I'm going to show you later with the charts. We're going to move forward with the RSI. I'm not going to bother you too much with the math, calculations and stuff like that. I'm just going to explain to you how it works, how it's built, and how to use it. So the RSI, the RSI, which is by default, the period by default is 14. So now I've seen many traders use different periods for the RSI, 33, 20, even 100, you're gonna have to adjust that. I mean, the most used one is the 14, right? But you want to adjust that depending on the time frame you're gonna be on and on the market volatility as well, because you would like to find the best compromise between delay and signal quality. So the RSI tracks momentum, particularly efficient for breakouts. Okay, in bull phases, it often lives between, I would say, books says 50 to 50 because it's based on the scale from 0 to 100. So when the RSI is between 50 to 70, we say that it's in a bullish mode, a buying phase, right? When it's above 70, we say that the market is overbought. And in those situations, we can expect a trend acceleration, right? But from experience, I can tell you that in bull phases, it often lives between 40 and 80 with a support around 40, 50. Okay. In bears, 20 to 60. resistance near 60, of course. So now you don't want to use the RSI to fade overbought. You want to use it to confirm when momentum is escaping a consolidation. Okay, typical breakout situation here, especially when the RSI breaks its own trend line ahead of price, because this is important to bear in mind, guys. I see many traders using RSI just with its first purpose to tell you if the market is in a buying phase, selling phase, overbought, oversold. This is just like it's just a tiny usage you can make of it. Don't forget that oscillators are derived from prices, right? From the market itself. So if you can draw, for example, a trend line on the market, you can likely draw it on the RSI as well. And very often, a breakout happens first on the RSI or the stochastics, and then on the markets. So this is a very cool anticipating effect from the RSI. I'm going to show you later. All right. So now we're going to talk about divergences now. Let's move forward. All right. Oh, I love that tool. Divergences, one of my favorite, honestly. So now divergences are, I mean, this kind of thing happen when the tops and bottom on the RSI diverge from the tops and bottom from the markets. Okay. So let's say you have two tops, sorry, on the market, on the actual chart, one higher than the other. Typical bullish phase, bullish trend, right? But on the RSI, when you look at the RSI, you can see that those two tops, the second one is lower than the first one. This is called a bearish divergence. And it usually tells you the information that the trend is slowing. So now, every trend reversal starts with a slowdown, with a trend slowdown. But every trend slowdown doesn't mean the market is going to reverse. Pay attention to this. So you want to use divergences only at real swing points. Again, you have to take some time to mark your markets. We covered that throughout the last sessions, guys. So you want to look at the markets and place some, intelligent support and resistances. If you can see a divergence happening close to a strong resistance, you may be, you may be likely to be ahead of a interesting price move, price swing to trade. Regular divergence hints at reversal. All right. Hidden divergence supports trend continuation, which is great for buying pullbacks in an uptrend, for example. So now this an interesting sequence would be like to use the context, then the RSI trend line break, then the price breaks the mini range, and then you define the stop under the range. Again, I'm going to show you that a bit later. Okay, that's it for the RSI. We're going to switch to the last one, the stochastics right now. And you're going to see how I'm going to show you the chart at the end of the session. And honestly, I know I'm not talking about, very sophisticated tools right here. All right. But what I'm giving you today is very, very powerful. So stochastics. All right. All right. So mastering stochastics, signal triggers. So stochastics basically tells you where the close sits within the recent high-low range. All right, we're talking about two lines here: person K versus person D. All right, I'm going to show you this. In uptrends, healthy pullbacks often bottom between 20 and 40. Okay, in downtrends, rallies fade between 60 and 80. It's sensitive. All right, it's way more sensitive than the RSI. RSI is more used for longer term, even on an M1 chart. Okay, it's used for large price swings. Okay, no matter what time frames you're going to use. The stochastic, on the other hand, is used on very, very small price swing inside a longer trend. Okay, it's very intense. It's very, very sensitive. You want to maybe prefer to trust crosses only when context agrees. Again, guys, all the signals that technical indicators are going to send you, you don't want to take each and every one of them. You want to use them as a tool decision making and link them to a market context. Okay, hence the importance to mark your charts the right way, basically. All right. So you want to use it as a trend filter plus structure. So now I have a little playbook for you with the stochastics. Okay. Let's say you're just like the moving average we just talked about. You're in a bullish environment. You want to play long. You want to enter the market with a long position. So with a rising 20 exponential moving average, draw a simple price trend line on the pullback. Look for stock person K line reclaim over the person D line from the 2040 area. As price breaks that trend line, very, very important. That combo says, basically gives you the information that the pullback likely ended and that the trend is ready to resume now. Of course, you want to mirror the situation for shorts and downtrends. Okay? So now let me show you. Enough of theory. Let me show you on the chart how does it look like. Ross, can you confirm you can see it? Just so I know.
Yes, yes, we can see it.
Oh, good. Wonderful. So now look. Oh, I forgot to put the stochastic on that chart. So let me put it. So you can see it on the MT5 platform. Technical indicators are sold out, by families, I call them. Trend, oscillators, volume, Bill Williams, and stuff. I'm gonna go to oscillators, stochastic oscillator. All right, let's go. Okay, so on the main chart, on the main window, you can see the moving average. This is an this is an exponential 21 period moving average in yellow. Here, on this window, you have the RSI, which is the blue line right here. And here, on the last window, you have the stochastics, okay? So now, this is a chart, this is a daily chart of the S&P 500. Okay, this is a live chart, by the way, all right? So the first thing that pops to your eyes is that the market is in an uptrend. Okay, again, we covered that. We have higher highs and higher lows everywhere. All right. Now look at the moving average right here in yellow. You can see how it follows, it trails the market. Okay, and now everything that I've just said to you regarding acting on pullback makes sense. Once you know that you are trading a market that's, or you're trying to analyze a market that is in a bullish trend, you want to buy the markets at a discount, right? So during pullbacks. So here, the market goes up, pullbacks on the moving average, then goes up, pullbacks to the moving average, and so on and so on and so on. So now look, pay attention. A few times you can notice that the market even went below the moving average right here. Okay, sometimes it's just a wick, but sometimes we have closure. Okay, we have closed candles below it. This is not a big deal as long as the moving average doesn't reverse to the downside. All right, it shouldn't be used as a big deal. And honestly, when some traders they don't want to take any risks, they want to be cautious about that. So as soon as they have a closure of the market below the moving average or below support or resistance or anything like it, they close their position, they exit the market. Okay, just to be cautious because they are scared that the market is going to continue the movement that is against the direction of their position. So now, me, I like to wait for confirmation for a second candle. So this can be dangerous because if the second candle is like 3 kilometers long, then you expose yourself to some, risk here. But sometimes, and actually it happened a few times here, we had a few closure below the moving average right there, but invalidated on the next candles and right here as well. Okay, but now basically the strategy that I told you about, the pullback strategy with moving average, makes sense. And now you understand as well how you cannot use that technical indicators on the ranges, right? I'm going to try to find a range. Like, look, for example, here during this phase, the market is, the market clearly lacks direction during that phase. You agree? So we have the end of a bullish trend here, right here. We have a closure, but the market goes below the moving average, then goes back up, then goes below again. This is untradeable, right? You want to use that inside an established trend, okay? So this is the first thing. Second thing is the RSI. And honestly, I'm telling you, this is one of my favorites. It's one of the most used one. It's not the most sophisticated ones, but honestly, this indicator is so powerful. So again, you can see the scale right here on the right side of the window from 0, 30, 70 to 100. So when the RSI, when the blue line is above the 50% level, it means the market is in a, I mean, the conditions are are bullish basically. All right. When the market goes above the 70% level, you can expect a price acceleration, which happens here actually. The market goes above the 70%, and we have a little acceleration right here. Okay. And mirror for the selling, I mean, the bearish condition. When the blue line is below the 50% level, it means bear are more in controls than bull traders. And when it goes below 30%, it means you can expect a trend acceleration to the downside, right? So now this is the first use you're going to make of the RSI. But the best use you can make of it is the trend line. Okay. So now look, and actually this is a live chart. Okay. I told you already. Let me draw a trend line on the chart. Okay. We have it right here. All right. We'll have something like that, more or less. Okay, I'm gonna put it different color so we don't get confused with the moving average. Let's put it blue like this. Right, okay. So the market is trading above an established bullish trend, like 1, 2, 3, and 4 impact actually in total. And what's funny here is that we have the same trend line here on the RSI, but the RSI has already broken out from the trend line, which tends to indicate that a breakout is also going to take place on the market. Okay. Again, guys, this should not push you to sell short the market right now. It's a decision-making tool. You're going to use it like this. Okay. So, but basically, this is on the RSI trend line, you have 1, 2, 3, 4, 5 impact in total. Okay, so this is a very valid one. Okay. And the second thing we can notice are the divergences. So look, you see this yellow line on over the last two tops here? We have the same on the market. Look, they took place at the same time. Okay, so this is a bearish divergences. On the market, you can notice like two tops, the second one higher than the first one. Okay, perfectly. I mean, it's the definition of a bullish trend, right? So nothing to worry about. But when you look at the RSI, you can notice that the second top is lower than the first one. This means that the trend is slowing down. And honestly, when I'm in front of such a situation, and actually we have the same situation on the stochastics, by the way. So you're in front of the market who has been trading in who has been bullish for a long time, like honestly since April, which is a very long time, even on the daily charts. And now you can see some sign of slowing down with the divergence, the bearish divergence right here in yellow. And now you have you have a trend slowdown. Sorry, you have a trend breakout from the RSI. This is another alert. First alert is the divergence. Second alert is the trend breakout from the RSI. And the third alert is I mean, it's not going to be an alert, it's going to be a signal at this stage. It's going to be with let's say the market breaks out from the trend line, okay, with a clear closure outside of that line, and you have the moving average reversing to the downside, then you have all of the alerts, and you know how to trade the markets, okay? But you want to wait for confirmation. This is what this is how you use technical indicators. Now look at the stochastics, okay? So stochastics, I mean, it fills the same purpose than the RSI, but on a smaller scale, okay? Look, we have the same divergence situation on the stochastics, but here we have the stochastics giving it's a low quality bullish signal. You see this cross, it means that it's a short-term bullish signal. Actually, we can see it here because the market's broken out its bullish trend, but then open above it and now still trades above it. Okay, so this signal has been invalidated by the market, and we can see that on the stochastic. So now this is not a proper. I said it was a low quality bullish signal because it happened above the 20% zone or more between the 20 and 80% zone. If you have such a cross happening above that level or below that level, which was the case, for example, here we have a bullish cross below the 20% level, and look what the market did afterwards. This was the start of the bullish trend. Now look, again, here we have a cross right there above the 80% level, okay? So this showed that the market was slowing down, and honestly, we had strong acceleration right there. And here we can notice a slowdown, okay, a little consolidation. This was again, you wouldn't take that trade if you read the stochastic, in the context of what the market is currently giving you, because at this stage, at the moment of that bearish cross, sorry, the market wasn't close to the resistance. The resistance level was right there, the last stop, and the RSI was not giving any information as well, right? It was around the neutral level, around 50%. Okay, so now let's try to find another one. Here, for example, you have an interesting bearish cross right there because the market is let me zoom out a little bit. So the market was so this is not a resistance level, but the market was in a uncharted territory because it was trading on a new historical high, basically. The RSI was in overbought situation again. So this is when you can expect another pullback. And actually, the pullback was just little, just two candles right here. Two candles on the daily chart is not much, but when you go to lower time frames like H4, sorry, H1 or M15, it can be a tradable movement, price movement actually. Same thing here. Okay, this one is a big one. You have the RSI overbought, okay, largely overbought actually. You have a bearish cross right there, and here you have a strong pullback first towards the moving average and then almost to the trend line. So this was a nice move to play. And again, this one, I'm sorry, but this last one, this last bar, fundamentally or macroeconomically speaking, you can explain it by Donald Trump sending a veil of uncertainty on the markets. This was during last Friday's session when Donald Trump unveiled some new tariffs towards China, 100% tariff on China. So of course, investors didn't welcome the news very well, especially equity traders. But again, this was announced. Honestly, this was already priced in the market. Like the market knew something was coming. Okay, for some time the market was kind of welcoming the fact that the Federal Reserve is moving forward with rate cuts and stuff like this. This is a good news for the markets, for stock markets, especially indexes like S&P 500 and Nasdaq 100. But here, when I see such a bearish cross after bearish divergence on stochastic on the RSI, this was interesting to trade, honestly. But again, you don't want to use solely the information that the RSI is going to give you, the moving average is going to give you, the stochastic is going to give you. You want to combine. This is true. If you want to retain anything from technical analysis, this is it. You're going to use trend recognition, chart patterns, support resistance, liquidity voids, gaps, stuff like this, technical indicators. Everything I've just said are part of technical analysis, okay? You don't want to use a single tool of this toolkit. You want to use many of them and see if they converge in the same direction. If they do, maybe you would like to take the decision to play that move. You know what I mean? But sometimes you may be facing some situation where all those technical tools like moving average, RSI, stochastics, or whatever else gives you different messages, different directions. Don't get confused. It's better to maybe not be in the market at this stage. But yeah, every technical analyst or every traders want to enter the market when they get some sort of convergence, of of signals. And again, and I know it's not the topic of today's session because we're only talking about technical analysis, but if you can combine all of this with a little bit of fundamental knowledge, like for example, honestly, now what do we know about the market, fundamentally speaking? We know that okay, John Powell, so the Fed chairman has spoken yesterday and said that the labor market in the US was worsening. So this is increasing the likelihood from the Fed to keep cutting rates, which is a good news for the markets. It's a bad news for the economy, but it's a good news for stock traders, right? For bull traders on the stock markets. But bear in mind that the situation in the US is it's very uncertain because Trump said what he said on last Friday. And also we are inside a shutdown situation where we lack many news publications. Well, we didn't have any CPI this week. We didn't have an FP reports on last week. So markets and the investors as a whole, they don't like uncertainty. It's just like when you drive a car. When you drive a car and you see some information that the weather is worsening, or you can get some fog or heavy rain and stuff like this, you tend to go slower. It's the same on the markets. When the situation becomes uncertain, investors tend to reduce their exposure and take it, slow. Okay. And this is where you can expect like, erratic price actions. I think the biggest danger for stock traders, for investors on the markets, is not bad news. Because when bad news happen, we know how to trade the market. We know that we need to short, basically. But uncertainty, the fact that we lack the ability to efficiently assess the market situation or the economic situation is a real danger to investors, right? So yeah. And so I think I've gone towards everything. I'm just gonna finish with a few advices, if I may say so. I want you to avoid some common pitfalls when you use those tools. Don't trade every oscillator cross. Respect the moving average slope. Don't force divergences in random ranges, and don't move stops emotionally. You prefer to write exit rules before entry and follow them. Okay. Here's a little recap for you to before we close this session. Moving average is your trend filter and pullback entries. RSI, stochastic are used for breakout confirmation using trend lines and divergences. Okay. But remember, context first, signal second, and risk manage. Actually, I'm doing a little bit of teasing right here because we're going to talk about risk management on the last session in 2 weeks. So context first, signal second, and risk manage throughout. Keep it simple and consistent. Ross knows me well, and he has heard me already said a couple times on the markets when I analyze a chart, I like the KISS method. Keep it simple, stupid. These are the best. Honestly, these are the most efficient ones. All right. So now this is it for me, guys. If you have any questions, please write them. We're going to take the time to answer to each and every one of you.
Be shy, put your questions there if you want. There's no open questions at the moment, Pierre.
Okay. Well, if there's no question, it means I've done my job properly, and everything has been understood, which is good. We're gonna be ending technical analysis with this session, and next the last two sessions are gonna. I mean, the next session is gonna be about risk management. I'm sure all of you have heard many things about risk management. I'm gonna give you some rules and basics about that. Give you a glimpse of how professional traders do it, and you will understand that uh, the most profitable traders on the market are not the best analysts, but the best risk managers, actually. And the last session, this is the one you don't want to miss because we're going to combine all of the knowledge that we discussed throughout those sessions to build a solid trading plan.
Okay, all right. There doesn't seem to be any questions, so we're all good, Pierre.
Perfect. Wonderful. Right. Thank you so much, guys. Please feel free to reach out to Ross and myself before the next session. If you have any questions, I'll take the time to answer individually to each of you. And meanwhile, if I don't hear from you again, have a good trading and be careful on the markets.
Thanks again, Pierre. Cheers.
Cheers. Thank you.
Bye.
Bye.